Good morning. My name is Samuel Gishohi, and thank you for joining us this morning. I'm going to be taking you through today's session. I'm Samuel Gishohi once again. I'm at NCBA Investment Bank, the brokerage department, and today I'm here to take you through the fourth in our series on investor education. The series is really meant to be able to help you to understand how the market works and various different things that can affect your investment journey. I'd like to start by really thanking you all because you have been very responsive to this series. We have gotten a lot of overwhelmingly good feedback on the series, and we are very happy to continue to ensure that we engage you and we keep you informed and we give you ideas on how best to run your investment journey going forward. The series that we have done so far, we began with a discussion on whether it is good to invest during the COVID-19 period, and we saw that there are several things, including your own personal financial wellness and your own personal financial health, that are important in making that decision on whether to invest in this period. We then came with the second in the series, the second episode in the series, which we discussed about how to trade online, especially now in the COVID-19 time, with all the isolation. We know that we don't have meetings. People are not coming, say, to our bank halls, and so it means that most people will be wanting to invest, but they can only do it online. So we have an online and a mobile investment portal which allows you to buy shares, to see your statements, and to see the market live. And we went through that so that you can be able to understand the different things and the different functionalities within that system. 2 weeks ago, we were back with another part of the series in which we brought the different statistical reports, the different research reports, both from Nairobi Securities Exchange and NCBA Investment Bank, that we usually send. And we have had in the past many people asking, what does things like price to book value mean to my investment, and all those different terms and recommendations were deciphered here by my colleague Dennis. So now today we are back, and for those who did not get to join us in the last three, you can access them, the previous videos, on our NCBA Bank Facebook page under videos. You can also go to our YouTube channel called NCBA Group, and there you'll be able to access them, watch them, learn, but please remember to share them with your friends. This is to help light candles. The more candles we can light, the better our investment journey will be, and our job is to create wealth. Our job is to help you grow. And so if we can share widely and let people at least get to know more about how the market works, then it is going to be very productive. It is going to be our goal in doing this series. Today's topic is very close to my heart. I'm excited about it because it is one area where very little is actually shared with investors. The reason being that it is an area that is not necessarily mainstream in terms of investment, but has continued to grow over time. There's a new financial area called behavioral finance, and what it shows us, or what has come out of a lot of research that's been done under that area, is that a lot of times we don't make decisions based on all the reports and all the different statistics that are available to us. There are a lot of incidences, and there are a lot of reasons why our psychological dispensation, why our emotions and our moods can cause us to be able to make decisions or can affect the way we make decisions. And for that reason, in today we are going to be looking at the behavior of investors, or emotions, and those things that those biases in terms of our way of thinking that affect our investment. So this psychology and the emotions, they actually play a lot of effect, and they can significantly impact the results of our investments. So remember, we talked about investor profiles, and when we do investment profiles, you will find that some of those questions in there, which you would probably be expecting to be about share prices going up or down, or different performances of companies, all the questions you look at for those who did our investment profile, and for those who want to do it, you're welcome. It's a free thing, and you can just send us an email after this so that we can be able to help you with that. You'll notice that a lot of them also have something to do with how would you feel if you lost money? How would you feel about A, B, or C? Those feelings are trying to figure out what kind of emotions are at play when you're making your investment decisions. Now, as we go along, please post your questions on the Facebook page, and we will be able to answer them as we go along. Now, I usually start with this picture. I know some of you will be looking at it and thinking that this looks like an old picture, which it is. I think it was taken either in the early 80s or the late 70s. And when you look at this picture, you can see that there's a group of people there. And a lot of the time, the reason I use this is because I'm looking at what sort of decision would you make if these guys walk into your office and they're asking you to invest your hard-earned money, assuming you have saved up 10,000 or 100,000, or is it a million, whatever you have, and they're telling you, we have an idea and we want you to invest in it. And invariably, when I show my clients this picture and ask them, would you have invested? I wish I could ask you that question live, but a lot of the time people would say no. And even when you go a bit deeper and ask, okay, would there be some of them who you'd probably invest in, you will find that they will choose the ones that look a little more decent. So you'll find them looking at the lady in the blue jacket, for example. But the other guys, because they look a little bit like hippies, most people will say, no, they don't look trustworthy. And that's the thing with investments. Investments may not look trustworthy, but it's what is hidden underneath. The best idea with this question would be to say, I would listen to what they're going to say. The reason being, first of all, these are actually the richest people in the world today. If you look down there, at the bottom, on your bottom left, is Bill Gates. And these are actually what we used to call the pirates of Silicon Valley. They're the ones who started the whole .com thing. And today you can see the sort of companies they run, Apple, Microsoft, etc. So when these guys were walking around telling people they could put a computer on a desk, and those days computers were big buildings, they were housed in big buildings, it looked like an impossible idea. And that's the thing with investments. A lot of investments will come to you dressed in very nice suits and ties. And we take their word because they look good. But we forget to look beneath the skin. A lot of time, the best investments don't look very nice on the top, or they are not dressed the way we'd like them to look. But underneath the whole investment picture, you find that it is actually a very good investment going forward. And the best people at picking investments tend to look at what is it about. If you look at it in our real life, you will notice that, just for the sake of an example, if someone approaches me on a street and they're dressed in rags, and they're trying to get me to listen to an idea, or even to talk to me, chances are you will tend to be a bit uneasy about it. But remember, the word conman means confidence artist. So it means that a lot of times somebody will win your confidence by the way they look outside, yet on the inside there's a different story behind what they want to do. So basically, the idea here is to look at investments with an open mind, to be able to listen to what is it about, what is happening, and not letting our emotions and our profiling of different kinds of what we think in the background be plaguing our decision making. Now, Albert Einstein, well-known genius among us, when he made a comment about human behavior, he said two things are infinite: the universe, and human stupidity. But then he goes on to add, "I'm not sure about the universe," indicating that he is sure about this, what he calls human stupidity. Of course, this statement might look condescending coming from a genius like him, and people might think that that's the reason he says it. But as we go along, you're going to see that we might be very good. Einstein might have been a genius in terms of those whatever physics stuff that he was doing. We are good at what we do. I might be very good at investment stuff. You might be a very good farmer, a very good accountant, a very good banker, what have you. But when we start acting, or when you look at humans as a group, certain tendencies start to come out that start to make you wonder what happened to that really good investment or in stockbroker like myself. The reason being, there are certain behavioral things. There are certain things that humans do. Like, for example, we are going to look at the herd effect. Things people do just because other people did them, without thinking about why the other people did them. We just do them because that's what people do. And so, again, even when we talk about living like the Joneses, you find that this is just human behavior that is not necessarily driven by a well-researched and a well-thought-out decision, but really just driven by emotions and our way of thinking. One of the best investors in America, his name was Jesse Livermore. And Jesse Livermore wrote a very good book. If you're an avid reader, you should look for it. It's called The Reminiscences of a Stock Trader. And Jesse Livermore is quoted saying that the Wall Street never changes. And at this point, I would like us to look at it, not as Wall Street, because Wall Street, of course, is where the markets in America are located. But look at it more like the market, because a market is anything. Nairobi City is a market. People come here to exchange goods and to trade. So this is a market. So when you're thinking about what we are talking about today, I want you to think about it not just in terms of the stock market or investment in shares. Of course, my examples will tend to be in the stock market because that is where I work. But I would like you to look at them more in terms of the market, like decisions you make every day as you walk on the street. And I'm going to give you examples, of course, based on the real world. And it says that the market never changes. The pockets change, the people with the money. The people who are the suckers, or the people who are losing or whatever, they change. The stocks, what is being sold within a market changes, but the market never changes. And this is because human nature never changes. And that means that in everything that happens in a market, as much that things are changing within the market, the people within the market, their nature, the way they do things will not change. And so it is a very important idea to be able to be watching what people are doing in the market for you to be able to make decisions. Warren Buffett, one of the best investors of our time and one of the wealthiest people in the world today, said that success in investing does not correlate with IQ. Once you're about 25, about the level of 25, and basically someone with ordinary intelligence, what you need is a temperament and control to control the urges that get other people into trouble in investing. Now, again, we are seeing the third of people who we probably would say, are important within, humanity and investment. Again, steering not towards prices, not towards company performance, not towards a research report, but more towards temperament, urges. You see, urges and temperament, that and intelligence. And this is now going towards what we call emotional quotient rather than intelligence quotient. That there's a lot of emotions. The roller coaster of investment is full of emotions, and so we are going to be going deeper to try and figure out what are these emotions, what are these things that affect our investment journey that we need to be aware of. Now, over time, what has happened, and in the past, the assumption in the market, and we call it the efficient market in hypothesis, is the assumption is that people make decisions on available information. People make decisions based on what they have access to in terms of information, what knowledge they have, and they make rational decisions. So, for example, they will go and look at the price of a company, they will go and look at the demand and supply, they will also go and look at the performance of the company, they will look at any information regarding the management of the company, then they are going to look at the financials and look at the profitability, and based on that, they will make an investment decision. Now, unfortunately, that is not so. Unfortunately, people will listen to all that stuff, and at some level, it becomes just noise. And they start to move because somebody else moved. Reason being that there are certain biases, and we're going to talk about them going forward, that cause us as humans to ignore all that technical stuff and again revert back to our emotions and our emotional state. And so that the reality in a market is actually a reality of irrationality. People make decisions not because we send them all these research reports and everything. And you're going to see it a lot of the time. For example, you're going to hear, say, the government make an announcement that they're going to put some money in a company to rescue it. And then the next day, there's going to be hundreds of thousands of investors calling us and wanting to buy into that company. Now, the question here would be, that money is being put into that company because the company is probably technically insolvent. Now, if it's technically insolvent, the chances, and if you look maybe at the fundamentals of the company, you will find that that company or those companies have been making losses. But now, because suddenly there's some information on the market and it looks like some money will be pumped into the company, suddenly, without talking to our analysts or without looking at all that stuff regarding their profitability, we want to buy. Why? Because everybody wants to buy it, because for some reason, sometimes we think that it cannot fail. So again, it then brings us to John Maynard Keynes' quote there. He says, nothing is more suicidal than a rational investment policy in an irrational world. The world is being irrational. You are trying to be rational. You've done all your mathematics. You've bought into something because they had very good reports and very good running of the company, but the price is going down. People are selling. Why are they selling? Because the world is irrational. People are moving in a different direction from what you think is the correct direction because you're being rational. And that means that even for the person who is rational, the person who is doing all the reading the research notes and doing the things, all these investment decisions based on all that technical stuff, at the end of the day, you have to take into consideration the irrationality. Let me give you an example. You're driving down Kenyatta Avenue, you're approaching the roundabouts, there near the Nyayo house. Now, you're in the roundabout, you have right of way. Then you see a matatu coming towards you. Do you stop or do you keep going? Now, I know most of you are thinking, I'll stop. But why? Because I think, one, we are Kenyans. We know that that matatu is not going to stop, whether I have right of way or not. Which means being rational would mean I would think I have right of way, so I'll keep going. But I'll then think in the back of my mind, wait a minute, that guy is irrational, so I would rather stop, do the irrational thing, and let him pass. So again, it means that this irrational behavior, this idea that people are making decisions based on emotions, needs to be part of your consideration when you're making a rational decision. So in finance, this is usually covered in a theory that is called the greater fool theory. And what the greater fool theory simply says in layman's terms is that people take their cues from price action. The price is going up, so I want to buy because the price is going up. A lot of the time you're buying because the price has already gone up. rather than looking at the values, rather than thinking, okay, why is the price going up? Or what could cause the price to go up? The idea is to buy. I mean, sometimes I use an example of the people who went and bought pieces of land in Roy when they were just small, they were just small bits of rock. They were, I mean, it was not agricultural land. It was quite away from town. And, they didn't look like they had any value. Now, those people bought when nobody was interested. So they were getting those plots, say, for 40,000 shillings. But years later, these people are the same guys selling to you that plot for over 1 million shillings. Now, but somebody else, and you'll hear it sometimes in our media stations, somebody is saying, oh, these plots and they were 1 million shillings, now they are 4 million shillings. You better buy it because they are still going to go up. And what happens is you run and you borrow money, and what you do is you go and buy the plots. But what happens is you tend to be getting in when already these assets are overpriced. It happens a lot in shares, as we'll see in when we talk about greed. But the idea, and that's the real thing, what the bigger fool theory says, you can't do something dumb expecting someone else is dumber and continue to do it consistently. So yes, you might do it and win once or twice, but generally, a lot of investors end up coming to the market when it's very late. Another good example I can use here, if you look at the period when we have elections, and if you look at a technical analysis of the share prices over time, starting from something like 2003, I think we had an election in 2003. In 2003, the year before the election, the market went up. The next election, I think 2007, same thing happened. The year between 2006 and 2007, when we did the election, the market went up. After the election, even in I think it was after 2007, it was 2013, all those years you will notice that the market before the election goes up. But most of us, when we talk to you during that period, you will be saying, let's wait until after the election. Reason being, there's a lot of uncertainty before the election, there's a lot of noise, and most people feel that, oh no, because people are worried about elections, they're not investing. Interestingly, the more savvy investors are buying before the election because they know everybody is waiting for the election, and at the election time, they sell it to you at a higher price. So then you start now to realize, so it means I would rather be buying shares in 2021 rather than waiting for the election in 2022 in order to buy the shares, because invariably, immediately after elections, 2017, it stagnated after the elections, and then we had we had issues immediately after that, economic and all that, and you will see that the market slumps. And that all the bears have happened after elections, not before elections. So again, this is something that generally people think, I won't buy before elections, I will wait for elections. So why does this happen? Now, moving on, it means that our market is run by emotions, and these emotions are a cycle. And as you can see there in that diagram, you can see that people will go with their emotions, and you will find that there's a point where it reaches euphoria. Now, an interesting thing to note, if you look at all IPOs, major IPOs, anytime there has been an IPO of an initial public offer of one of the biggest companies, be it AT&T, be it IBM, be it Kengen, be it Safaricom, be it Alibaba, be it Microsoft or Apple, all those major IPOs always happens when the market is around a stage of euphoria. Why? Because that is the time people will be able to have a lot of money, they're liquid, and they're very positive about the market, and they want to get into the market. Very few people will come and try to sell you something during these COVID-19 times. If I was trying to sell a piece of land, chances are now would not be a very good time to be coming to sell it to you unless I'm giving you a huge discount, isn't it? So a lot of the time when I'm reading the news and I'm looking at the news saying billionaires lose billions in the stock market, that is usually a sign to buy for the savvy investor. It is usually a negative sign for most investors, Just like elections, they think this is a bad time to buy because of all that noise out there, without realizing that that is the time when assets or those prices are low. So sometimes our emotions and the situation outside our environment causes us to move. Again, we see Warren Buffett there giving us a very good quote, saying most people get interested in stocks when everyone else is. The time to get interested is when no one else is. You cannot buy what is popular and do well. So now you're starting to see him now talking about even something like the hard effect, where everybody goes to buy something in the same place because everybody else is doing it in the same place. That is also part of what moves a market. So let us now go a bit deeper into the discussion for today and ask ourselves, so what is the market? Because it means the first thing we need to do is to understand the market. Now, under normal circumstances, we would start talking about a market being a place where buyers and sellers come to exchange goods, etc., etc. But based on what we have been discussing, there is another element in the market. The element in the market is the people element. And in the market, we find that it is made up of three different people. Walk into a market, be it Gekomba, be it Nairobi Securities Exchange, there is buyers, there is sellers, and there's undecided people. There's those guys who are just walking around. They don't know what they want. They're not sure what they want, but they know they should be in the market. So the question I usually would like to ask here is, which of these three do you think is the most important? Now, this is where you start seeing how human, what Einstein called human stupidity, but human way of thinking becomes biased. A lot of the time, if I ask you that question and you tell me the bias, if I follow up that question and ask you why you thought that way, you will find that you are thinking of selling something. Let me explain. If I travel, say, to China, and I have some per diem in my pocket and have some money left and from my savings, maybe, and I feel maybe I should buy something from my savings to bring back home and maybe I can sell. I would be, when you are in such a situation, your thoughts tend to go into, will I find buyers? So what is driving your decision to buy something is, does it have demand? If you look at a farmer, when he's planting something, his biggest issue is the market. Will I be able to sell? So when you are somebody like that, who is the most important person in the market to him, then in that case, it is the buyer. The same thing with the buyers. If you're the one buying something and you're going to Nairobi to buy, of course you're going to be looking to go where there is people selling that product. But that buyers makes us ignore the most important factor, and that's the undecided people. The undecided people are important because, as Steve Jobs once said, people don't know what they need until you give it to them. Look at the iPad, for example. It was given to us, we had never seen something like that, and you can see the phenomenal success. But when you have owned an iPad or a tablet for a while, you start to realize that it doesn't do, there's not much difference between what it does and what your phone does, and you can put a keyboard and it becomes a laptop. So again, you start to wonder, do I need to be carrying it around because it's rather bulky? But we bought it, didn't we? Why? Because of the kind of marketing, the kind of ideas we were given on how to use that thing. Look at politicians. Why do they campaign? They campaign to change undecided people into their voters. Why do we do marketing? We do marketing to make undecided people decide. So that means that if you're working in a market, your biggest question should be, what would make buyers become sellers? And what would make sellers become buyers? You see, a market is controlled by three things. In a market, what we say actually, it's a saying. We say, buy the rumor, sell the news. In this case, the buyer and the seller, if you walk into my office and say, I want to buy shares and I want to buy Safaricom shares, that is news. You already know what you want to buy. So we are going to have a very short conversation. Do you have the money? Yeah. Here's the Safaricom. Goodbye. But if you come in and say, I'm thinking of investing, but I'm not sure what, I'm going to spend half an hour discussing with you because I need now to give you the information you need to make a decision to be a buyer or not to be a buyer. And in that case, it means that the most important person is to figure out what will cause people to decide to either become buyers of something or to become sellers. So when you walk into a market, the first thing and the most important thing that you need to be looking at is what are undecided people doing and what are they likely to do next. That way, you are able to figure out that if I buy a plot here, it looks empty, but this is where the undecided people are likely to come next. When they come, you'll be making a killing. But again, you can see that that is an emotional thing. It has nothing to do with the technical side of things, but you need to be very cognizant of it. That is why a company which is doing very well can bring bad news. If the bad news can make the undecided people they feel they don't want it. The other two things that I want to talk about briefly is fear and greed. Now, greed is easy. I remember when Safaricom came to the market, it came at what, 5 shillings a share. When the Safaricom was listed, and I think foreigners were buying it for 5.50. 3 days after Safaricom came to the market, it went from 5 shillings to 8 shillings. That's 60% gain in 3 days. Now, that excites a stockbroker very much. So I'm calling you and I'm saying, hey, Chief, hey, your shares, banner. Remember the Safaricom, they've gone up. They're now 8 bob. You bought at 5 bob. Guess what most of the people would answer? Most people are like, no, it's going up, so let it keep going up. Now, the moment you do that, you have lost out on one of the most important things. Reason being, you have gotten an opportunity to make 60%, or you got an opportunity to make 60% in 3 days. If you annualize that, if you could actually make that 60% or 30% every day for a year, you will see that even without compounding it, you're going to be making over 12,000%, which means a million would have become more than a billion. But because of our emotions, we start thinking, no, if I sell it now, it will go higher. Now, the moment you do that, greed has taken over. You're thinking, what if I sell and it goes higher? But you're forgetting one important thing, and that is where we do the risk profile, that you need to have an objective. Never buy anything that you do not know what you are willing to sell it at. So that when the price when you're willing to sell it at reaches, you're not thinking twice about it. You make the decision and get out. The same happens on the downside. Okay, and we'll see that again as we're looking at the biases. If I buy something and I lose a certain percentage, is it worth holding on to? Of course, based on the reasons, sometimes it is preferable to actually get out, because sometimes we are holding on to toxic stocks that we shouldn't be holding on to. Now, fear is another thing altogether. Now, I always ask people, what do you fear when you invest? You can answer that in your living room, but I can guess that most people answered the fear to lose. But that begs the question, why then do we buy things at a high price? If you're fearing to lose, then you'll be looking for it at the lowest price. But again, we find that people will buy a piece of land when you've been told these pieces of land were 1 million, now they're 4 million. This share was 20 bob last month, now it's 30 bob. Now, when we form our decision based on that, and we've seen the greater fool theory earlier on, it means we are not fearing to lose. We are fearing to lose out. Now, the fear of losing out is very interesting. Even a matatu tout knows that. When a matatu is the only matatu on the stage, what does the guy do? He starts shouting, "Ya mwisho twende." Instead of asking the guy next to you if this is the last matatu to go, or whether the last matatu goes at 6 p.m., what happens? You get in because you're fearing that you will lose out on going home, or you will get late. One net twende, you've seen them telling you that there are only 4 people more to get in, but when you get in, someone gets out. There's always a guy sitting there to pretend the matatu is full. They're actually playing with your fear of losing out. That guy who sells you a nice tie or a nice shawl, what do they tell you? There was only 10 of them, but I have only 2 left. You see? And in fact, the guy calling me is the guy who wants to buy the other one. You immediately tell him, don't pick the call and borrow money or whatever to buy it. You buy it at 2,000 shillings, only to walk down the street and find that everybody else has it. That's the fear of losing out. You have to be very careful. Don't buy things because you're fearing to lose out. Buy things because you have seen the value and you have seen that they are worth and they're at a price which can give you future profits, or their whatever utility it is to them. But the moment we start making a decision based on that, it is a dangerous thing. So we are now looking at how do we create the desired financial personality. We are seeing that there's that financial long-term goal, which is investing for the long term. And at this point, let me say, when you're investing for the long term, the rule is never take money out of your investment account. It doesn't mean buy a share, it goes up, you don't do anything, it goes down, you don't do anything, it goes up, you don't do anything. 10 years later, you're still holding it, and the price is where you started in the first place, and maybe they've never paid you dividends. Long term means that it goes up, you look at it and decide, if I sold it, would it be a return that is worth selling for? Have I beaten inflation? Have I beaten other risk-free asset returns? And now I can sell it and look for something that is at a low price, but you're still investing. That's what investing for the long term is. Now, when you put money in something and stay with it for 10, 15 years, what you're doing is you're investing for dividends. That's dividend investing, not long-term investing. And I think we discussed that when we looked at compounded interest. Then again, there's no short-term fluctuations. Notice I've told you about 10 years investment, but in the middle, there's a lot of fluctuations. So how do you make decisions on those things? And you'll notice that those fluctuations cause a lot of emotion and a lot of emotional decisions to be made. Right now, somebody will probably tell you, oh, you know what? With COVID-19, we are finished. We are not going to survive. So let me just sell my shares and get away from it. That's emotions. So apart from the investor, advisor, client information, and this is what the financial DNA that creates what we are talking about in a financial personality, there's that investor, advisor, client communication, which is what I'm doing right now, trying to communicate. And of course, we do it on phone and discussions. And then the risk profile I talked about earlier. And of course, there's those behavioral biases that I'm going to quickly cover next. And then we have to tie that in with your goals and spending patterns. So you see, your financial personality is defined by all three areas. We have a lot of information regarding goals and spending patterns, which are all quite personal. But this can be set using the risk profile. We have a lot of advisor-client communication. We saw that as we discussed our form, our research notes, and our statistics, and the company results. But at the end of the day, behavioral biases and your risk profile have a very, very strong thing. Some people will not buy certain shares because of their religious inclinations. Some people will not buy certain shares because of environmental issues. Those are emotional issues, and they can affect how your shares move. So let's look at some of the biases that we have. I hope you'll tick them off as you find those ones which have affected you in the past. One is loss aversion. People focus obsessively on a loss. Nobody likes to lose. I don't like to lose. So when people lose something emotionally, they don't understand where they lost. They didn't want to lose, and so you keep going back to that. I have seen people come to me who bought a share. Let me just give one example. In this case, a share like Mumia's at 46 shillings. They averaged it down to 40. They averaged it down to 30. Now it gets to something like 20, 30 cents. Of course, right now it is suspended. And they're still feeling, no, I can't take that loss. But I mean, something that has lost over 80, 90% of its value, surely is not something you would want to be putting more money. You're throwing good money after bad money. And so that means that obsession is called loss aversion and is very dangerous. It is always good to, and that is the importance of the risk profile. It's always good to have a downside, that if I lose 10, 15% on this, I need to look at why am I losing? Because a good company can turn into a bad company. A good industry can turn into a bad industry. A few years ago, cement was very big and very good industry to be in because of all the building and all the real estate growth. Now, because of COVID-19 and the last 2 years, we've had a bit of a slowdown in real estate. You can see that will have an effect. So sometimes it is always good to restructure and say, okay, this is going down. Maybe I should sell and buy this because this is going up. I will recover my losses if that goes up. So I'm fine. So again, be very careful of loss aversion. The hard instinct. Of course, that one is we do things just because other people did it, and suddenly everybody runs to the market. Interestingly, everybody wanted to buy Safaricom. Why? Because we were at euphoria level, not necessarily just because it was the most profitable company. All the other IPOs before that had performed very well and people had made money. So now you wanted all to come in and make money. And I remember asking somebody, if everybody is buying it to sell it, then who are they going to sell it to? So again, you need to look at why are undecided people all buying it. Okay, then who are they going? Because they want to sell it, and if you listen to them, they're all saying, "No, I want to buy." Then 1 month later, it will go from 5 bob to 10 bob, and then I'll sell it. Which means suddenly you will have a huge supply coming in, and then you won't have anyone to sell it to. So again, stop doing what other people are doing. It's your risk profile is individual for a reason, because your emotions, your thoughts, your ideas, and your investment patterns are different from everyone else's. You have your own signature. So do your risk profile and it will help. Then there's what we call mental accounting. Mental accounting is where I worked and I got 5,000 shillings. Then I went for a meeting and we were given a sort of allowance of 5,000 shillings. Now, we have, as humans, we have a tendency to treat these two different amounts differently, saying that I wouldn't want to lose any of the one I worked for. So if I buy something, I don't want it to lose any. But because this one I was given, it's okay, I can take a risk, and if I lose it, I didn't have it anyway. But what you're doing is mental accounting and forgetting that a loss of 10%, whether it is on the money you were given or the money you worked for, is still a 10% loss. So at the end of the day, stop differentiating, put your assets in one pool, make a decision that affects all of them, regardless of the source. That mental accounting really messes people up, because then you start creating different pockets and treating money differently. Money is the same. Your investments are all supposed to be working for you, making you money, and so you cannot treat them as two different things. A loss here is a loss everywhere. Limited attention span. Of course, there's a lot of information, and that was what this limited attention span was one of the things we were trying to deal with last week when we were talking about the different statistics and the different ratios and the different recommendations, etc., that we give about the stock market. Because bounded rationality means that there's so much information coming, and so what happens is you feel, okay, it's too much information, let me just go with the one I know. So you're going to be looking, say, at the banking sector, there'll be all those banks, and then you'll end up thinking, okay, they're all banks, let me just pick the one I know. And so what happens is you make a decision, probably even pick the worst one of the group, just because you bank there, or just because you know somebody there or something. So that is bounded rationality. And that is why we try to do as much as we can if you need information about a particular thing, but also try to zero down on a certain area that works for you, rather than trying to do the whole thing, because then you get affected by that. Then overconfidence. Now, all of us think we're cleverer than the other guy. All of us think, okay, they lost because they're not as good as I am. And so a lot of time you see us making very bad decisions in terms of investment just because of overconfidence. And you need to be very, very careful, because sometimes because we were lucky and we made a few good picks does not mean that we are gurus. And you'll find it even with us who are investment advisors and have been in the market for years, we still make mistakes. And sometimes these mistakes happen because you think you already know. So again, be very careful about that. And then regret. Everybody does this, you know. You're confident about something, and then you thought nothing can go wrong with it, and then things go wrong, and then you keep regretting. But remember, investment is not for the faint-hearted. And the longer you're taking to regret, and of course you can tie this to loss aversion, the more you're hanging yourself out to dry, because then you are risking and you're putting yourself at risk of making very bad decisions and of now beginning to succumb to fear. Because when you have regret, then it means now you start being so averse that you stop making objective decisions. So we see a lot of losses of wealth, and most spectacular losses of wealth are usually made because of, one, people gambling. And you can see that gambling is coming because of overconfidence, because of loss aversion, because of fear, because of greed. And you find people just gambling, and the gamble fails. And of course, that creates a big loss. The other issue, on the other area where we have seen in the market where people lose a lot, is concentrated positions because of a particular faith in an asset. My brothers from central Kenya, you can say amen at this time. This is when we remember our plots everywhere. Amuru Wako plot, where there's a plot, and we have all these plots, but we are not using them. They're not assets at this point. We are not using them as assets. They're just there. So what happens when a period like this, when real estate is in trouble, happens? All your plots will be a problem because you cannot even sell them. But anyway, I have nothing against owning plots. I'm just using it as an example. So don't take it too personally. But again, you find somebody coming and saying, oh, you know, I was a banker, so me, I only like banks. I know how banking works. So you go and buy 5 banks. You haven't diversified. You need to diversify. Have that plot, have some shares, have some wealth management products, you know, something like a money market product, have, you know, some bonds. All those help you to manage your risk. Some are liquid, some are illiquid, some are high risk, some are low risk. That all works towards you beating inflation and making profits over time, and your assets working very well for you. And of course, where investors did not know but should have known the risk they were taking, and in this case, that is what we are trying to address in all this series of episodes we are doing in this series for investor education, so that now you have a level where you understand what happens and what sort of risks you may be taking, so that you can be able to overcome them as you invest. So again, the important choices that you make based on all those emotions we have talked about are buy, hold, or sell. Let's not limit them to buy or sell. Let me give you an example. I buy a share today at, say, 20 shillings. The share has very good fundamentals. The company is doing very well, etc. Then 2 weeks down the line, what happens is I realize that the share price has gone down by, say, 10%. Do I sell? Of course, my risk profile says that I should look at why I bought it in the first place. If you can't hold it for 10 years, don't hold it for 10 years, don't hold it for 10 minutes. So again, I'm looking at the long term, where is this company going in 5-6 years? But in the few days down the line, I have lost some money. Now, I will go back and look at what were the reasons I bought it in the first place. If those reasons are still there, it is still a good share, it is still performing, the company management, all that is still okay. Then I look at the other, what we call externalities. Then you might find it's just COVID-19. So it means that my question would be, is this external factor here to stay, so it will cause me to stay in loss or lose more? Or is this problem just a short-term problem? Chances are it's a short-term problem, and when it goes away, then chances are things will get better. Then I think my decision would be to buy more, because then I will be averaging down my price. But if I look at the company, things are going wrong, there's theft, there's management, there's corruption, there's I don't know what, so many other things, chances are I would be better off taking my 10% loss and moving on. If it's a very short term, but I'm not sure about the other, the longer term, maybe I would just say, let me hold it and see what happens. So all those choices, always try to look at what are the emotions behind them. What is driving your thinking? Because you might not be objective if there's an emotional. Maybe somebody was fired from the company and you think they're the ones who are causing it to thrive. That's a bit emotional, I would say. Was it about their performance? If they were not performing, then it makes some sense to worry. But if they were not performing, then I don't think being a friend would be a reason to sell. So that is what you can see on the screen is a day in my life, the day in the life of a trader. And you can see me right there on your top left corner. And this is really just showing you how the Chinese telephone works and the sort of emotions and the sort of things that happen when you're following the heart. So this guy is saying, I have a stock that could really excel. and the guy next to him hears the word Excel, but by the time it reaches the fifth guy, everybody had the word sell. Now, if you think about it, this guy was telling someone to buy, but now everybody is selling. So you can imagine down there, you can see he's confused. This is madness. I can't take it anymore. Goodbye. The moment he says goodbye, people think he's saying bye. Now, you're seeing that making a rational decision in an irrational market. This is a very nice, cartoon just showing us how the market will tend to move against what you think is rational. Reason being, the people around the market are irrational. And I hope that once you start to look at the people in the market, I'm sure today when you go to the market, you will start to look at, you'll start to look at what's happening in the market. What demand, supply, who's driving in, how many trucks with carrots are coming in, what are people doing, what are people buying, why are they moving to a certain, area, or why are they more interested in something? And you will see that starting to be more aware of what is happening around you in terms of human behavior will tend to help you become a very, very good investment decision maker. And as I come to a close, of course, again, this was Warren Buffett. Value is king. Always look at the value, the underlying value. What is the company doing? How are they doing? But the information that you have, not just information about the company, the information you have even about people's behavior, what you're seeing and what could make people become or decide to move in a certain direction is very important in your investment decision making. Thank you so much for taking that time. I've taken about 10 minutes more than I expected to, but now I'm going to take a short sip of my water, short break, and then I'm going to go into the questions. Thank you for listening, and you can go to our Facebook page, the NCBA Bank Facebook page, post your questions there so that I can start to at least cover them and we can be able to look for answers. Now, Evans Nyangaya, you're on YouTube. Thank you for joining us and thank you for your question. What do you advise on shares that offer good dividends but declining value? Should one stick to the shares? Very well. Evans, I don't know if you were with us last week, but if you watch what we talked about, you will see there is a point at which we talked, I think, about compounding. But anyway, what do you advise on shares that offer good dividends? Now, shares that offer good dividends or companies that offer good dividends will tend to be what we call defensive shares or defensive companies. Now, defensive means they have good market share, they have flows or they have revenues that are predictable, they don't shake too much, in times like this, COVID-19 and everything, they have a presence, they are well-known companies. And they're mature, they've been around for a while. Now, the reason they pay good dividends is because they have reached a point where they are not growing much more. So their earnings are not going more to retentions or to building, say if it's a bank, building new branches and everything. And so they have more money that they can be able to distribute. It's not always the case because some companies can just be making huge earnings. But generally, that is the kind of picture that you have. Now, the reason you start to see declining value is because investors on the market tend to use what we call the net present value of growth opportunities. They are looking at where is company A going in 5 years. If the company is going to grow in 5 years, then chances is they are going to be investing more in that, and if they're investing more in that, then the share price, the capital gains will tend to go up. Now, those companies that are growing in that way will also be tending to pay you less dividends. Reason being they're using most of their retentions or their profits to do what? To invest as capital expenditure, meaning they're going to be building more branches, maybe they're going to be rolling out new products, etc. So what you need to look at in the books of these companies is to look at why is somebody retaining these funds. If somebody is retaining to pay, say, bad debt, then it doesn't become a growth company. But if they're retaining, for example, there are certain companies you will see retaining they give you a bonus, don't give you the dividend because they need the money. They'd rather give you a share so that they need use the money to, and they will have it in their reports. We are going to open a new branch or a new plant. We have a new product going out there which we want to support, and that will tend to reflect on the price. Now, if you're going to be doing a dividend company and it is losing in value, then again, you are gaining on one end but losing on the other end. So you need to decide, do I get a growth stock that gives me a small dividend, which is a win-win situation, or do I stay with this one that is stable but losing in value and giving me dividends, which are probably only offsetting the value, so you're not really beating inflation? Another way to deal with it is to say, every time I get this good dividend, I reinvest it, so that next year I am earning dividends on my last dividends. So your share number keeps growing and your dividends. And I think we are going to cover this whole concept when we're looking at investment strategies in our next session coming up. And what is going to happen after 2 weeks? Next week we are doing wealth management. And so what happens now is that you get a dividend, your share was 5 shillings, you get a 1 shilling dividend. So now next year you're going to earn dividends on 6 shillings, right? Because now you have a new share, you bought new shares with the dividend. If you keep doing that, then what you're doing is you're introducing what we call the compounding effect. You invest all dividends, then your number of shares keeps growing, which means your dividends keep growing on the other end. So again, this decision is really, what are you looking for and where do you think the better value is? Do I then shift from that and go into what is giving me dividends and growth, or do I stick with what I have? Rachel Kinoti from Facebook. Can we have a tailor-made class like this for our children, especially from 8 to 18 years? Hallelujah. Rachel, you got it. We're going to do it. Let's communicate. And I'm sure, yes, we're going to talk about it. I take that very seriously because I believe we have a huge gap. Our youth, most of us started investing because we started working and earning money. There's nothing in our schools talking about investments. So I think that is a very good idea. Thank you so much, Rachel, for suggesting it. And I'm very happy. We are very happy to do that. Shadrach Geshohe from YouTube. How do we maximize an opportunity for investing without being late in the investment scene? Shadrach, one, try to read as many of those investment reports that you have. Keep your ear down, listen, most of your financial advisors, we have the information on what's going on. The news will have information on what's going on. But a lot of the time, you need to be looking also at the external factors, what is happening? Is it a politically charged time? All those things will come together. But let me tell you what, as we have said again severally, be close. And you saw in that slide where I was talking about the investor DNA. I'm going to pull it up there. You can see that there's that advisor-client communication. That is where a lot of it happens. It's always good to be, to call your advisors, have a discussion around what's happening with my portfolio. Let me tell you one of the things that I have seen work really well. A lot of the time we will send a generic email to all of you, our investors, telling you we think A, B, C, D. But you see, because your risk profile makes you a unique individual as an investor, then your situation is different. But a lot of people read that and then keep quiet. Usually when you ask us, okay, so how does this affect my portfolio? That means you're looking for a discussion where we say, okay, your portfolio looks like this. This is what we think is happening. Maybe we could change A, B, C, and we would be in a good place. And you would be feeling maybe not, and we will discuss it and come up with what is good. So in that discussion, we are dealing with your profile, your behavioral biases, and your goals and your spending patterns. So I think communication is important, and also those discussions with your advisors so that you can now be able to see and be in the know. Try to join even groups that are talking about investment, because when something happens, markets are about events, what is going, information, and there's a lot coming in. Of course, deciphering it has a lot to do with your communication with your investment advisor. Moving on. Pauline, how do you differentiate between emotions and wisdom in financial decision regarding investment? Emotions are making a decision based on your feelings. Wisdom is channeling, being able to control those emotions and channeling them in the right direction to make the right investment decision. So there's a difference. Remember the story of the talents. One guy was given 5, one guy was given 2, and one was given 1, I think. If you look at why this one guy lost, and remember, talents is that story of talents is all about investments. To be honest, there is a time, time value of money. They don't really tell us what the two who made double did, but they might have invested, maybe planted wheat, and they lost one harvest. The next harvest was good, but by the time the boss came back, it was double. But the guy who lost, it's a purely emotional issue. Remember when he brought the money back, he said, "Master, you are a wicked master. Taking from where you did not plant, you reap from where you did not plant." So because of the fear he had of this wicked guy, he went and did nothing with his investment. So you can see the difference between this guy. I'm sure the other guys knew this guy was a wicked master who reaped where he did not sow. But they were able to take care of their emotions and channel the emotions into doing something good with what they have been given, which is what I think is wisdom. Thank you so much for that question. Evans Nyanaya, I think we have already talked about that. Let me move on. Is there a maximum amount of saving to qualify a loan in a group? Dorothy. We can deal with that offline. Dorothy, please communicate with us because this is more about loans and that is more about the banking side of our business. But we will help you to talk to the right person and we will be reaching out to you. Joseph Kimani. How can I choose the best broker to manage my portfolio? Johnson Mwangi. That is Joseph Kimani. Joseph Kimani, how can I choose the best broker to manage my portfolio? Now, choosing the best broker there's a personal, I don't think you've ever noticed that stock brokerage firms traditionally will usually be associated to names. Yeah, Morgan Stanley, things like that. Same as lawyers. So it just indicates any businesses which you see they have that tendency, it means that there's a huge relationship factor. It means that your relationship with your advisor is the key to your portfolio. And you've seen that in what is down there with the advisor-client communication. So when you're choosing a broker, the most important thing is, can you reach them? Are they able to listen to your needs as an investor? Are they able to advise you? Do they give you enough research and information for you to be able to make financial and investment decisions? Because again, the market is about the information available to you and also the ability to decipher it. So again, when you're selecting a broker, because at the end of the day, brokers don't necessarily manage your portfolio. They just advise on your portfolio. And our brokerage situation, what happens is we are your advisor and we are your executor. We give you the platform to execute. However, if you're looking for a portfolio to be managed, then what you will be looking for is a wealth manager, which we offer here at NCBA Investment Bank. And that means you would be looking, they will do a risk profile, they will be able to see what sort of investments suit you. So again, it's looking at how they engage. And once they have engaged you, they will decide, are they going to put you in their money market fund, or are they going to put your investments or in the equity fund or in the dollar fund? And once they do that, they even have personal wealth management, which is private wealth, and all that is really a factor of their discussions with you. But once you have given them all that information, then from then on they manage your portfolio without you having to be directly involved in the day-to-day buying and selling, unlike on the brokerage side. Johnson Mwangi. Gishoi, greetings. Mzuri sana, Johnson. Lovely session. Always happy to hear you speak. I have a fun. Thank you, Johnson. How Could you comment on insider trading, how it happens and whether it influences the prices of shares on the market? Well, I won't make much of a comment here because that is really a regulatory issue. How it happens is probably I would give you an example of, I would probably say, for example, if I work in a particular department in a company that is listed, so you can imagine, sometimes we usually say, if you see accountants leaving en masse from a company, something is wrong because they've already seen what the numbers look like. So you can imagine I work for a listed company. I know I work in a department which maybe does the financials. And when I'm doing the financials, I see something that could affect the price of this share when we announce our results. Then I go home and I meet with my friend. Let's assume we meet somewhere with you, Johnson. And as we are talking, I tell you, hey, let me give you a tip. You know, this company, as where I work, we've done this and that and that. And you know what? When we announce our results, they'll be like 10 times better than last year. So Johnson goes and trades based on that information. That is insider trading because you're trading based on information that is not available on the public domain. And so if it turns out or if it is found out that I gave you such information, then we are culpable for prosecution. So that is how insider trading happens. And yeah, it can influence prices because then somebody who knows what other people don't know might go and, you know, if they have the financial muscle, might go and be able to manipulate prices. But I think that is how it happens generally. Victor Hezekiah, YouTube, on YouTube. As a professional, would you advise someone to invest in cryptocurrencies? We don't have the regulation and the underlying, information about cryptocurrencies, so I would choose not to discuss that on this forum. But I have not. I don't have the author. I'm not an authority in that area, so I cannot be able to advise you well about it. I think that is all the questions I have at the moment. Of course, we are going. Oh, there, I got something else here. Julius Mwangi, the money market has a low risk. True. What does this mean? I know my principal is maintained, but do we have my money protected under law that I cannot wake up one day and the firm I invested in has gone under? Julius, thank you for the question. I think one thing you need to understand is when money or when funds are being managed or any fund management company, those funds are not necessarily controlled by the company who is doing the wealth management. They control the decisions. Your money is under what we call a trustee. It is held separate in a different place, and all the decisions they make are vested by what we call trustees. So what happens is there is a separation between the manager, the person managing your money, and your money itself, which means the assets that you hold, if the company managing your money goes down, it does not go down with your assets. The risk that you have is them making bad decisions with your money, but not, which means that you lose value in terms of the assets you hold, but not necessarily that if that company went down, it will go down with your money. It is really probably the same case with brokerage. Your shares sit in CDSC. So a brokerage firm going out of the picture does not affect your shares because your shares are still owned by you. So again, those two are not necessarily mixed. Now, money market has a low risk. What does that mean? A money market fund is invested in money market securities. When we talk about money market securities, we're talking about short-term securities, and usually they're interest-bearing. So we're talking about T-bills, bonds, maybe a bit of shorter-term bonds, and those kind of investments. So they're really more interest-bearing, and it means that there is an underlying, they're kind of loans that you're giving, to say the government, and so they tend to be considered risk-free. And because of that, It is how they manage now to put them in the right ones and the ones that give you the highest returns. And you'll also notice that a lot of the time their returns will be very in tandem with what you'd be seeing on what the fixed income markets do. And that is why we call it low risk. Unlike an equity fund is a pooled fund that is invested in equities, and equities are more risky. So you'd see more of the up down, and it means even your principal could be affected if, say, the market slumps by 20-30%, unlike a bond or a T-bill, which pays you interest coupons. So that is how your principal is maintained. Sylvester Njagi is asking, hello, I appreciate your enlightenment. Thank you very much. My question is unit trust. What is it and how do you venture into it? Sylvester, I have good news for you. Next week, we are going to have a session on wealth management. So next week, we are going to sit down and tell you about unit trusts, our unit trust funds, and all our managed funds, which are what I was just talking about. And we will ensure that you get all the information. But I don't want to leave you hanging dry, so I'll quickly just explain what is a unit trust. Now, when you come to me to invest in shares, for example, Sylvester, assuming you come to me with 20,000 shillings. If you come to me with 20,000 shillings and you are looking to invest in, say, a portfolio of shares, we will have a problem. The reason being, let's assume we pick two shares. Let's assume we pick KCB at 35 and Safaricom at 28 and equity at 35. How many shares can you really buy? And you see, you're confined. You can't. I don't even think you can buy more than 2 or 3 different shares. So in terms of diversification, you're limited because of the amount of money that is available to you. And that means that your portfolio then becomes more risky because your value, your eggs are concentrated in less baskets. So now what happens then if somebody comes and says, Sylvester, give me your 20,000, Gishori, give me your 5,000, Wainaina, Onyango, Mozayo, or different guys from everywhere come and put into that pool. Now once we have that money, because we have many people, just like say the way a chama is, right? You have now say 5 million shillings, right? Now with 5 million shillings, I can easily even buy into every share in the market, which means I have diversified. I can take 250,000 and buy bonds. I can take another 250,000 and buy cyclical, which are very risky stocks. I can take another 250,000 and buy those growth stocks I was talking about earlier, and then take another 250,000 and buy those defensive ones which give me dividends. So you see, I can actually put my portfolio in a very well diversified situation because of pooling. And so a unit trust is just a pooled fund. The reason it is checked in units and not the amount you actually invested is because then I came with 5,000 and you came with 20,000. So within the pool, you have more units than I do. And so rather than trying to count it in terms of the number of shares, it is given to you as a unit of the entire pool of investments, which is worth your 20,000 shillings. So that is, I think, a simple explanation of what a unit trust is. And I'm sure next week, when we have our session on wealth management, and please join us, we will be very happy to have you again. We have really been enjoying engaging with you and hearing what the questions you have, because then they inform us on what is next or what we should talk about. So the wealth management, or rather the discussion which will be about the unit trusts next week, is really informed by the fact that every week we have had a question or questions relating to unit trusts and wealth management, which is why now we feel that it is very important that we bring this topic to you. Once again, let me come and request that you go to our website, www.investment-bank.ncbagroup.com, That's our NCBA Investment Bank website. Please take your time, go there, look at our products and what we do. We are very happy to be there and to assist you in your investment and your investment banking needs. Don't forget, we do advisory, which means that if you need, you have a company, you're looking for, say, private in capital investments to come to you, all that, we are here to advise you. If you are looking, for example, to do wealth management, I've talked about that. Even if you're looking to list your company, let me be honest, we have the segment GEMS, Growth Enterprise Market segment, of which I believe we are nominated advisor, so you can come and we can help to advise you. You want to structure or restructure your balance sheets, all that is done under advisory. And you can come for us to also do your brokerage needs, which means we also have a brokerage, and we can be able to assist you. So this is a place where all your investment needs are taken care of. And I believe that we shall continue to engage you and to give our best to ensure that your investment journey is smooth and profitable. Thank you so much once again. Have a great week. Thank you for the feedback, and God bless you. See you next week.